Hi everyone, good afternoon. Thanks for joining this live webinar with Admiral Markets. My name is Chris. We'll be taking a look at strategy today, taking a look at breakout and bounce trading specifically. First of all though, be aware that this webinar is shown to a global audience but may not be suitable for everyone. Please visit admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity for more details. Also, please be aware that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. Alrighty, so we're going to take a look at the market right in a second. Just for interest sakes, please take a look at admiralmarkets.com. and you'll find a lot of extra information regarding the market heat map, regarding the calendar, regarding analytics, fundamental technical wave analysis, and a lot of articles too. So would encourage you to do that. Regarding the movement, the market heat map that we're looking at right now, you can see that pound odd, pound New Zealand, pound CAD, euro odd, one of the top movers in volatility and in direction. So those are something to keep in mind. Euro Swissy, New Zealand CAD, CAD Swissy, New Zealand Swissy, pairs that didn't really move too much, so those might not be as interesting. All right, so that's very useful information from the heat map. All right, let's take a look at the charts right now as we speak. So yesterday we were talking about basically the euro dollar and how it's approaching a resistance level, and I explained that I expected a breakout yesterday above 108.28. Now it has not happened as yet, but boy is it close to happening. So let's discuss a bit about why I was anticipating that. Let me start with the blank chart so we can discuss that. I want to basically kind of walk through the things that we discussed last week, which were basically looking at 3 time frames, looking at the highest time frame is the strongest support or resistance. The second, the time frame below that, is like a medium strength, and then the third one is the weakest level of support or resistance. So, for instance, well, it depends on what time frames you yourself like. But if I look at my trading, for instance, daily chart is something I use often. That is then a strong a chart where strong support or resistance is viewable. 4-hour chart will be medium strength, and the hourly chart will be weaker level of support and resistance. But if someone's a scalper, the 1-hour chart could be the highest time frame. So these 3 time frames will vary from trader to trader, right? That depends. The point is that the highest time frame is the strongest one. The medium one is the middle one, and the lower time frame is the weakest. That's basically the theory. All right. Now, besides that, we talked about basically price approaching. How many times is it approaching resistance or support? So on a higher time frame, on the highest time frame that I use or you use, the first approach I would expect to bounce. So the first time price is approaching a strong support or resistance level on a higher time frame, I'm expecting price to have a bounce and respect that level. All right. If it's approaching the second time, that could be 50-50, and the third time I would expect a breakout. Third and fourth time, I'm expecting a break. So it depends on when price, how many times is it really approaching that strong level. All right, that's something that will depend from situation to situation, but that's basically counting the attempts for price to break. So now that particular count is valid for the highest time frame. For the lower time frame, the lowest one, it depends on the situation. I might be looking for, it depends on the structure of the market, whether I'm looking for a break of the weakest support or resistance or a bounce. Typically, I'll be looking for a break on that time frame. Whereas I'll be on the medium or the stronger level, time frame level, I could be looking for a break or bounce On the weaker one, I typically look for a break, but it could be a bounce too. All right, but this particular count of the first, second, and third approach is most valid for strong, but could be really used on all time frames, I think, to be honest. Okay, so those are the things I think that we, if I remember correctly, what we walked through and talked through last week. So I wanted to use the same concepts, but just kind of rehash it a bit and dive into it a bit deeper. All right. So let's take a look at the daily chart on the Eurodollar. All right. So first of all, what we want to look at is what support or resistance levels do we want to reckon with? Which ones do we want to kind of count in our analysis? So what I use is typically around 200 candles. This is a bit more. This is already 260. This is a bit more zoomed out, let's say. So we could zoom in by one, and we'll be looking at 160, I think, here, or 130. So, that depends. I think 130 is probably better. I use often this particular time frame view, this kind of level of zoom, because I just see a bit more of the price action. So naturally, I kind of incline to this view, but probably this one is optimal because it gives us clear kind of information about what's happening now, but it also gives us relevant information about the past, but not going too far in the past. Because if you have something like this, you see a ton of information, but not all of it is really going to be that useful and valuable, and it becomes a bit distracting, right? So how much do we zoom in? Is this the optimal? This one? Is this optimal? That is the question. If you want to zoom in all the way like this, it's also okay, but that's just for looking at most recent candles, looking at the last 4 candles and trying to see exactly where the high, low, open, and closes, which you can of course also see by clicking on the crosshair and going to the close of the day, and you'll get all that information, the open, high, low, close, volume, time. You'll see all of that by going to the candle close, right? So you don't have to zoom in that much, but if you really want to see it a bit better, you can zoom in. But the optimal balance is something like this one is probably the best one, depending on which screen you use. Some screens could be a bit bigger, or this one, right? But this one is probably the best. So everything that's visible on this chart has relevance for the market, is within a relevant time period, is within a market memory, let's say, that has influence on this chart. So, because otherwise, how far do you go back? You could go back all the way here and start plotting resistance and support on the chart, but is that really relevant? All right. So from that point of view, another thing you can do is use Control Y, and you can basically add these vertical lines to it. What you'll see here on a daily chart is the beginning and the end of the month. So each of these vertical dotted lines represent the start and end of the month. So this would be the start of March right here. This would be the start of February. This would be the start of January and the end of December, right? Relevant periods are certainly the last 2. Okay, so when looking at that on this daily chart, we can add a resistance level right here. That was the high of the previous period. We can add one more resistance line at the high of the period before that, which is right here. So there's a double resistance. Now you can maybe understand why it's a strong zone as well. We can add the support levels of that zone, which are here and here. All right. So that's from the last 2 zones. If we want to take all resistance and support from the entire zone into account, we could add a level here. You can make it slightly different color just to indicate it's a different level. All right. Now, why am I taking these levels? Because they represent tops and bottoms, right, that have not been broken yet. Okay? So this particular low, let me see if my drawing tool is open. Yes, good. this particular low, it's really not a fractal as yet. So, we could debate if that is an important level. We might say, okay, only fractals. In fact, it's not a fractal. There's no two candles. So I'll take that one away. I like fractals. One way you can do to add a fractal is very simple. Go to Trend, Bill Williams, add fractals. Oh. All right, there we go. So the fractals that have not been broken are valid support and resistance. So all these fractals, these resistance fractals, why resistance? Because the fractal is on top, have been broken because price is already above it. You see that current price is already above those levels. So those fractals have been broken. But this fractal, and you can see there's no fractal here, but this fractal, and this fractal, and this fractal, and this fractal, and this fractal, they have not been broken. Price has not pushed through it. So those are support levels that we want to reckon with. These not, because price has indeed pushed through it already with this particular price action. All right? On the resistance side, you see that this fractal and this fractal and this fractal have not been broken, but this fractal actually has. Let's see. Why do I have this level here actually? Yeah, this is the high of that zone, right? So it's a different level. We can keep that one there. This is the high of that particular zone. So there are two different ways that we're looking at, two different ways of plotting support and resistance at the moment, but that's okay. One was with control Y, one is just looking at fractals that have not been broken, okay? Both are okay. So we're looking at strong support and resistance. Now price is approaching this level for the first time, right? There has not been, well, you could say that, it depends. You could say that this is the first attempt and this is the second attempt, right? So it depends on how you count it as well. From this point of view, we could say it's a second attempt, that this is the first attempt to retest or test this original fractal, right? Okay, so from that point of view, it could be both a bounce or break, could be equally likely. So this is the first step, is recognizing where is the decision zones, where are the key levels. We can use support resistance like this. We can use fibs too. I was a long time using this fib. No, sorry. I was using that fib. But after that, I was using this fib, right, for turns at these fib levels. Those were key levels in my opinion too, right? That fib, though, is not so relevant at the moment. But at the time, it was. So this is just horizontal tops and bottoms. Fractals are one thing. Fibs are other tools I use. The Admiral Keltner is a band indicator here. Another thing I use, moving average. There are a lot of ways to look at support or resistance. It's good to choose the ones you like, that you find useful. And it also will depend on the time frame. On the daily chart, I will use different ones than on a lower time frame. On the daily chart, I'll use tops and bottoms, but not on the hourly chart. On the hourly chart, it doesn't make that much sense, I think, because I'm using the tops and bottoms from the daily chart. So that depends again on what type of trader you are, but that's what I do. Just saying that support and resistance, there could be various ways of looking at it, and it also depends on the time frame you're looking at. All right. So, and the type of trader you are. So this could be a bounce or break spot. On the daily chart, I think both are possible. That's why I was looking for a turn at these fibs. And the next question is to wait for, one thing could be to look at price action at this zone. So there are a couple of ways, a couple of things I'm monitoring to see whether a bounce or break is more likely. One of them is candlestick patterns at the decision zone, and that will give me an idea if it's a bounce or break. I look at time patterns, wave patterns, fib patterns, candles in general, right? That gives me more information about whether there's going to be a bounce or break, because ultimately price is feeding us, is showing us that story that we can interpret to understand what will most likely happen. So yesterday, excuse me, yesterday I spoke about the fact that yesterday's candle All right, yesterday I said today's candle, of course, is important because if the candle close is near the high, 10, 20% away, only 10, 20% wick on top of the candle, then that looks like the bulls are controlling the candle, are in control of yesterday's price action, and there's a good chance that we'll see a retracement of the daily candle and then a continuation higher. So let's take a look at yesterday's candle. And the difference between the high and the low is 100 pips, exactly. And the close is only 12 pips away, or let's say 13 pips away from the high. So let me do the math for you. 13 pips wick on top, but a 100 pip candle. So what percentage wick does this candle have? 13%, right? Pretty simple in this case. 13 divided by 100 is 13. 13% wick. So anything within 5 to 10% is excellent. Anything within 20% is good. So we had a good close near the high. Anything that's within 20, 25% is good. If it's 33%, anything between 20, 25, and 30, 35 is okay-ish, depending on, let's say, maybe the larger picture. But more than 35%, especially more than 50%, the wick is quite substantial and is, not that interesting anymore. It's showing maybe perhaps a bit of weakness, but not necessarily a reversal. If the wick is more than 2/3, more than 67%, then there could actually be cause and reason to look into reversals. Not an automatic reversal, not like, oh, it's 67%, boom, reversal is around the corner. But no, it is that not, but it is kind of okay enough, the wick is large enough to say this might be an indication of weakness and might lead to a reversal. But we need 67% wick for a pin bar, for instance. Those are the percentages I use when looking at wick versus candle. Yesterday was 13%. That's a good daily candle close. So yesterday's candle indicated that the bulls remain in control despite the fact that resistance is nearby. So there's no price action signal, no response to that resistance. This is the second attempt, which means that the breakout on the daily chart is, I think, has a better chance. All right, so if we're looking for a breakout on the daily chart, because of all the things we just mentioned, then let's take a look at the next, let's say the medium time frame, the one time frame lower. Keep in mind again that you don't want to see too much of the chart. I just zoomed out a tad. We're seeing 130 bars. All right, so now we're looking for a bounce or break. So how could we look on this time frame for a bounce or break? There are here two various methods we can use. Price could go back to a pivot point, for instance, right, which is not something I use on the daily chart, as you noticed, but I do use on lower time frames like the 4-hour and the hourly. All right, so again, an example of using different indicators on different time frames. So pivot points is one, moving average, a fib, Keltner. What else do I use? Trend lines, chart patterns, yeah, time patterns. So all the tools that I usually talk about, basically, I could tackle here. So it's that depends from case to case which one of these tools I think could be most interesting. All right. Basically, at this point, I was talking about putting a fib on this candle. Yesterday, I was talking about that. So let's use that one because that's the one I actually discussed, in how I wanted to tackle it, right? And I was saying 23.6, 38, 50 fib zone, typical for a retracement at this kind of juncture, right, with the daily candle like that. If the daily candle closes near the high. So one way could be a bounce. A bounce trade on the 4-hour chart could be one way at this fib, and that could have been one way to tackle it. But it could also have been just a, let's say, a zone to keep an eye on, and then to look on the hourly chart for a reaction at this fib. So we're looking for a break on the daily chart, a bounce on the 4-hour chart, and on the hourly chart, for instance, we can see if there's some interesting candlestick pattern, for instance, that could lead to trading this fib, a reaction that could be interesting. So it could have been this bullish candle, for instance, maybe this, but this particular candle, I don't know, it did have a wick at the bottom, but I don't think it was that particularly interesting. But it could have been maybe, so if a more aggressive trader perhaps could have said this is enough wick, enough reaction for a potential bounce at this particular time frame, getting the confirmation of a bounce on the outer chart. But it could have been the 4-hour chart too. In this case, it's both are possible in a way. From a time perspective, we are looking at 1, 2, 3, 4, fifth candle. So this is actually still all one push, in fact, one push still. But for instance, let's say on a 50-minute chart, if I'm looking for a bounce at the fib, right, on the 1-hour, 4-hour chart, but I want more confirmation that price is actually bouncing, rather than trading right at the fib, I could be looking for breakout after the bounce. So we're looking for the daily chart, a breakout, right? On the 4-hour / 1-hour chart, kind of similar, we're looking for a retracement bounce. Bounce and breakout. And on the 50-minute chart, could be looking for a breakout. So this is how we can kind of combine different bounce and break ideas, different time frames to build a trading plan. So the breakout itself was this candle right here. That was the breakout candle. Now that could be the trigger and entry. If you really want to get into specifics, it could actually be the trigger but not the entry. The entry could actually, and this is, we could get into very, very large detail because this could be the trigger, but the entry could be actually halfway the candle after the retracement, in theory. So you can play a lot with these concepts to ever and ever greater detail. And the disadvantage of that is the trade might be missed because you're kind of like getting more precise in what I'm looking for, and it might not happen, and the trade is gone. Right? Of course, the advantage is that you're kind of optimizing reward to risk in a way, right? If you do this at the right spots, of course. So, and this is something where I get practice in. All right, so here in this case, the difference would have been just a few pips, but regarding the reward to risk, that can make a difference, right? 5 pips lower could help the reward to risk ratio in some cases quite substantially. So, but the point is that this was the breakout candle, and whether that's the entry or not, or at a different spot, is again actually another story, another step. Yeah, so that's something we discussed yesterday. Now with the strategy talk more in mind, I have nothing to add at this point. Besides the fact that if the daily chart, the next daily candle, one second, let me get rid of this fib, all right. The next daily candle could have basically the same relevance, the same analysis could be relevant for today's candle as well, just like yesterday's candle, right? Because if today's candle yet again closes near the high, and if this candle preferably closes above 108.28, then it will close above the Keltner. The Keltner is at 108.29.5, so a close near the high above 108.30 would not only break the Keltner, it would break this resistance top, and I think that would signal a potential follow through higher, right? Especially if the candle closes near the high today. So is this part clear? So do you have a particular time frame, particular currency pair you want to look at? Because perhaps now that I'm telling what I think about it, it seems maybe logical, but if you're looking at a currency pair on your own, you might think, how would I look at it? So perhaps you have a suggestion, a currency pair that you're not sure of how to analyze it, how you want to analyze it, and I'll share my view on that. In some cases, it could be possible to look for both. In some zones, they could be used for both a break and a bounce, and then it depends on how price will respond to that level. Will price respond there, and how? And then I adjust my opinion based on that reaction. So price action, always very important. Candlesticks, candlestick patterns, very, very key in understanding the psychology of the market and how price will respond to those support or resistance levels. So for me, it's not only about the support or resistance, but definitely also about how price is responding to those levels. All right, that's something that's a very important part of analyzing, the support or resistance. Confluence, of course, is another thing. The more confluence, the stronger the support or resistance will be. All right, that's something we can't dismiss. Confluence, very, very important. Momentum too. The more momentum, the more likely price will break rather than bounce. Less momentum, there'll be probably a bounce. If there's divergence, there'll be probably a bounce. So all of these things are part of the equation. Confluence, momentum, lack of momentum and divergence, chart patterns will indicate how strong is the support or resistance, and then the price action in combination in relationship as a reaction to the support or resistance will give us the final decision on that. All right, so let me write that down for you. So we have confluence, momentum, divergence, basically, those two things are the key things. Then you get basically the value of support or resistance, and then it depends on the price action in relationship to that support or resistance, the candlesticks. What I also look at besides the candlesticks is, as I mentioned already before, waves, time patterns, fib patterns. Okay, so let's take a look at another currency pairs. Let's take a look at, I don't know, let's take a look at dollar yen. Why not? So Alrighty. I had this fib on. And why did I think that was a good fib? Because there was a lot of momentum between the top and the bottom. Price, not only that, but price was also correcting lower in a very corrective way, as you can see. Momentum up, correction down. So those fibs are important. We can also add, as I said, other support and resistance levels to the chart. We can add the tops and bottoms of the last two fields, like this. The highs of each, and high and low of each of these, the last two sections, which are these four lines. We can also add fractals and see which levels have not been broken. Let's do that right now. All right, so we can add a level here that basically that covers all of the support until here. And we have some resistance here, tad higher here, and here. That's it. All right. So this is looking at the playing field, at this moment. Okay. And we saw yesterday that price was basically reaching back down to support, right? It was testing the support level again. And I say again because this is the first time and this is the second time. First time, it's more likely that it will bounce. Remember, this is a high time frame, so it could break. Of course, there's always a chance, but there's more chance that they will bounce. And it did. It bounced, and we saw one more upside. Then, this is the second time. So here I would say both could happen. I'll be looking for bounce and breakout, as I said yesterday. So very important, in my opinion, was how does price respond? How does the candle itself respond towards that support level? That's why I said keep an eye on the daily candle, just like the Eurodollar. It's actually pretty similar to the Eurodollar, but just has a mirror image, right? That candle indeed had a good candle close near the low. Let's take a look. Candle high low is about 133 pips. The close was about, sorry, I miscalculated here. No, it's correct, 133 pips, and the close was about 24 pips off. So we can divide 24 by 113, no, 133, excuse me. Yes. 24 divided by 133. So that is about, well, it's about 18.5%. Quickly calculated out of the top of my head. Slightly less than 20%. Why? Because 10% is 13.3, so 20% is 26.6. As you can see, 24 is lower than that, so it's just a bit lower than 20%. Still good, not as good as the Eurodollar, but still good. So after yesterday's candle, a breakout was imminent. A breakout was more likely than a bounce. If yesterday's candle would have been different, if there would have been a 67% break, I would have said a bounce is probably more likely. If it was between 33 and 67%, then it depends on the overall market structure. I would probably be more neutral. This was 18.5, was below the 30-35% zone. Therefore, bear's break was more likely. So again, here, dollar yen, daily chart looking for a breakout. On a 4-hour chart, we can see, take a look if there's any opportunity to look for bounce or break as well. And that's because the daily chart I'm looking for basically as an analytical chart, right? If I would be trading higher time frames, the daily chart could be my entry chart, but then I would be looking for a combination of using daily, weekly, monthly charts, right? So that's a different story. So 4-hour chart, we're looking basically at, let's see, yeah, the 4-hour chart of, let me take a look when the day ended. Yesterday, right about here, this candle. So here we're looking for a pullback and continuation or an immediate breakthrough. We didn't get the pullback, so the immediate breakthrough could have been a 4-hour candle that is a significant candle close, but we didn't have that really upon this break as yet. An hourly chart. There we go. An hourly chart. Okay, we got a break of this fractal right in here. So, that could be an example of a breakout right here. This candle, for instance, could have been a breakout candle for that breakout to the downside, or on a 50-minute chart, for instance, as the day finished with yesterday's daily candle breaking out. Another way could have been to look for candlestick patterns, chart patterns like this, a triangle here, a bear flag, a bigger triangle like that. Those would have been chart pattern potential on this time frame, wave patterns. There could be even Fibonacci tool use, for instance, but I don't think it made a retracement here. It rather bounced, so we had no retracement, but it could be put on the chart. Let's see what else. Two bearish candles here, breaking through this support. So those could be breakouts basically on the hourly chart. On the 50-minute chart, there could be bounce trades as well, as basically price breaks, like here for instance, and hooks back 5 to 6 candles, not breaking these resistance levels, could be an indication as well that the retracement has finished. For instance, this is a bull flag, so 1, 2, 3, 4, 5, 6 candles, not breaking this high, so that correction could be over. It still challenges it, but then starts to descend. So those are all kind of different tools I use to hunt for an actual break or bounce on a time frame of entry. So the analysis, the trend chart, daily chart was a break. The 4-hour chart could have been looking for a bounce, for instance, or on a lower time frame, if we didn't get the bounce, but an immediate breakthrough, then I could be looking for continuation breakouts, for instance, using chart patterns as I just described. So those could have been ways to try to find an entry as the daily chart was telling us that the breakout was about to occur. That was the analysis based on two simple things: support and resistance confluence, momentum divergence, and analyzing the support and resistance strength in general, right? And we saw that a breakout was possible, and that the daily candle confirmed it. So bearish breakout was the kind of the mental bias, the analysis from the daily chart, and then the 4-hour and the 1-hour and the 50-minute charts were ways to to look for on the lower time frame, to look for bounce and breaks in that direction. That's it. All right. So do you have any particular, yeah, we looked at pound yen yesterday, for instance, and that it was in a big range, that the pound dollar was important, the dollar yen breakout. So dollar yen broke to the downside. I mean, had a bearish day yesterday. The pound had a bullish day yesterday. So from that perspective, there was no conclusion there, I would say. But despite that, the pound yen actually did break to the downside. I didn't like it too much yesterday because it was in the middle. I said it could still bounce up like this, but I would expect still price to get down to the bottom in any case because it's in a big range, remember? It did just that, right? It's in the middle, so it unfortunately didn't make that small little bounce yet. I was talking about the fact it could fall right away or make a small bounce and then fall. It fell kind of right away. But it didn't, this time it didn't bounce in this zone. It actually broke through it. But what did I say as well is that if it breaks either up or down, it will probably head back very quickly into that zone. I didn't like the breakouts myself on the pound yen. All right, so is this clear? I mean, is this something that, is it more clear maybe than after last week? Does it, does these examples, yeah, luckily yesterday we had good examples to work with that were explained pre-fact, so that's great. But does this make sense to you? This is the way I look at bounce and breaks in any case. I enjoy this. I like it. I find it, you know, gives me a good way of looking at the market. So I enjoy that, and kind of use multiple time frames, use bounce breaks, counting the times, looking at support and resistance, and then looking at basically trend and patterns for the market structure to see what will happen most likely, candlestick patterns to make the final call. All right, but I always start with the higher time frame because that's ultimately going to give me, you know, what I'm looking for, a bounce break, which direction, or both perhaps, or nothing. Maybe it's just not interesting. Yesterday we had examples where price was with the pound yen and sorry, dollar yen and Eurodollar. Those were examples where price was at a decision zone. It was at a spot where it really had to show its kind of true intent, right? It was it's forced to kind of, well, not forced, but it was likely that it would have to kind of really make a decision. Whereas the pound yen, for instance, but there are others as well that didn't seem to be, and that could happen, is that they're not at the spot that doesn't seem like, you know, it could go either way, and it doesn't seem to be in a spot that has a higher kind of, it's not a decision zone, let me say it this way, right? So once again, is this material, is it clear, or do you have any follow-up questions? Let me know now through the chat, and we can take a look perhaps at one more currency pair. If you have anything in mind, let me know. In the meantime, you can check out more webinars. Nenad had just his webinar finishing an hour ago, right? When we started, it was just finished, I guess, roughly. Wednesday's live trading session with Nenad. Tomorrow, we take a look more intraday breakout and bounce trading. Thursday, right here at 6 p.m. Central European time, 5 p.m. GMT time. Next week, we got the same schedule with a different topic on Thursday, but same schedule. If you're interested in more analysis, technical analysis is available for you. Wave analysis is available for you. That will give you also more idea about the market structure, about what kind of patterns I'm looking at. So you can see that in wave analysis. You can also look at technical analysis to see, of course, what Nena thinks. Right there. And we have, for instance, more information regarding platforms, WebTrader, MetaTrader 4 Supreme Edition, and of course volatility protection. So you can find out more about that. So I don't see any questions, so that's great. Everything is clear regarding bounces and breaks. But if you're looking at the recording and you're wondering, you have some particular example that you're not sure how to tackle the charts, that's always something you can reach out to me during this webinar. Often I'm the one showing you my views, but I gladly hear back from you. I gladly take a look at your screenshot and take a look at how you're looking at the market, because this is ultimately a good way to learn. If you're preparing a chart for someone else, you prepare the chart differently than if you only prepare it for yourself. This actually helps you improve your trading, especially the first few years. Eventually, of course, you get into a rhythm that you feel comfortable with, so that's not needed if you're already trading lengthy period of time, obviously. But if you want to learn and if you want to improve, it's a great way of doing that. Share the screenshot with me. I take a look, look at a currency pair. You make your analysis, but you're wondering how I look at it and if there's any difference between the way we look at it. Send it to me. Make a screenshot, prepare it, send it to me. I'll take a look. I'll share my opinion. You'll share your opinion. We'll see if it's the same or even better, it's different, and we can discuss why it's different. And who knows, we might both change or one of us will change, That's the great thing. By challenging each other's view, we all become better. We all learn from that process. So I highly encourage you to do that. It's a great way of learning and getting to the next level. All right. If you feel that you're in that phase. All right. So great. That's about it for today. Thanks everyone, and talk to you soon. Cheers.